Hi everyone, and welcome. Today we're going to walk through Apple's March quarter, Q2 of fiscal 2026, and this one's actually interesting. For the first time in a while, the headline isn't iPhone or services. It's a region everybody had written off. Let's get into it.
So here's the thing. For what, 2 years now, every Apple Bear deck has had the same slide. China is shrinking, China's done, Huawei is back. And then this quarter happens. Greater China revenue up 28%, not stabilized, not flat, up 28. That's the biggest single surprise in the report, and it changes the conversation.
So the report has two big stories, and they pull in opposite directions. On the way in, China rebounded, the Pro iPhone mix lifted everything, and the company posted its biggest March quarter ever, $111.2 billion, up 17%. On the way out, R&D spending grew 34% year over year, faster than revenue, by a lot. We'll come back to what that means.
Quick context in case anyone's joining cold. Let's look at what Apple actually is in 2026. 5 product lines plus services. iPhone is still the gravity well, 51% of revenue this quarter. Services is now 28% and growing fast. Mac, iPad, and wearables together are about 21%. They matter, but they're not what moves the stock. Hold this picture in your head for the next 10 minutes.
Apple sells you a device, that's the funnel. Then once you're on the platform, they sell you services on top. App Store, cloud storage, music, ads, support. And those services run at a 76% gross margin. That's the whole machine. And almost every regulatory fight Apple is in right now, DMA, Epic, the DOJ, is about who controls the seam between those two layers.
Apple's competitive position is honestly kind of unique. They're the only one of the trillion-dollar platforms that actually owns the device. Microsoft sells you Windows, but Dell makes the laptop. Google sells you search, but Samsung makes the phone. Apple makes both. That's the moat. And it's also exactly why every regulator on Earth is, paying attention.
One more number to put in your pocket. $45.6 billion in cash, $23 billion in current marketable securities, $78 billion in long-term securities. Round it to $147 billion of liquid assets. That's the war chest going into a year where tariff and supply chain costs are genuinely uncertain. Now, let's get to the actual quarter.
Here's the headline scorecard. 6 numbers, 1 breath.
Revenue, $111 billion, up 17. Net income, $29.6, up 19. EPS, $2.01, up 22, which means buybacks did some lifting. Gross margin, 49.3, up 2.2 points. Operating income, up 21. And the one I want you to pay attention to, operating cash flow for the 6 months, $82.6 billion, up 53% versus the prior 6 months. That's a lot of cash showing up.
$111.2 billion, Apple's biggest March quarter ever. And importantly, this is after what, 2 years of growth in the low single digits? Plus 17 is a different gear. 4 quarters of revenue. The shape you see here, that big December quarter spike, that's seasonality, holiday sales. The thing to notice is each bar is meaningfully above its prior year. Plus 16 in Q1 of fiscal 26, plus 17 in Q2. 2 quarters in a row of double-digit growth after a long period in the low singles. EPS grew faster than revenue, 22 versus 17, and that gap is the buyback effect. Fewer shares outstanding mean each share gets a bigger slice. Operating margin pushed past 32% on services mix. The one negative number on this slide, effective tax rate jumped 2 full points to 17.5. That's a real headwind worth a few $100 million.
The inflows, where did this revenue actually come from? iPhone, $57 billion. Services, $31. Together, that's almost 80% of the company. Mac, iPad, wearables together are about $23 billion. They matter, but they're not what moves a quarter. The swing this time was iPhone and services. Apple revenue, 4 quarters. The seasonality is huge. December quarter is 2/3 of the year. But look at the year-over-year moves. Plus 23 in Q1, plus 22 in Q2. That, my friends, is what re-acceleration looks like. And Apple's own commentary names exactly one cause: higher net sales of Pro models. People are trading up.
plus 22 on iPhone after years of mid-single digits. And the cause is, well, kind of elegant. The same number of phones shipped at higher prices because more people bought the Pro. That's a hardware company finding a new gear without a unit miracle.
Services is honestly the most important chart in the whole deck. Up 16% year over year, but and this is the part, gross margin on services is 76.7%. So every dollar of services growth lifts the company-wide margin. It's why blended gross margin went from 47 to 49.
The supporting cast: Mac up 6, iPad up 8, wearables up 5. 6 new products launched in the quarter, including the new MacBook Pro and the MacBook Neo. None of these moved the needle by themselves, but the fact that they're all up is the thing. There's no broken segment in this report. 5 regions, every single one up double digits. America's up 12, Europe 15, Japan 15, rest of Asia Pacific 25, and then there's that line, the red one, Greater China up 28. There's also a foreign exchange tailwind helping every region except Japan, but the underlying demand is real. Same picture on a map. America is still the gravity well. Europe and Greater China are the second tier. China just caught Europe in year-over-year growth rate. The 2 Pacific regions together are about $17.5 billion now. The map is more balanced than it's been in years.
Inflows are the easy half. Now the outflows. Top to bottom, 111 of revenue. Cost of goods sold takes 56 and change, leaves you 55 of gross margin. Then R&D takes 11, SG&A takes 7.5, gets you to 36 of operating income. Tax takes 6, net income 29.6. The 2 interesting numbers are R&D growth and the tax rate. So here's where the spending got loud. R&D went from $8.5 billion to $11.4, plus 34%. SG&A grew but only 11, basically tracking revenue. R&D is the line. Apple's own words, higher infrastructure-related costs and headcount-related expenses. Infrastructure. They don't say AI, but the language matches every other hyperscaler in the past 18 months. Plus 34% on R&D versus plus 17 on revenue. That's a real choice. Apple is quietly building something, most likely AI infrastructure in silicon, that the financials don't yet justify. Either this becomes a story in the next 4 quarters, or this slide becomes uncomfortable. The other quiet line, effective tax rate up about 2 points, 15 to 17.5. That cost Apple about $4.4 billion in extra tax dollars over the first half compared to the prior year. Not a headline, but real money. $82.5 billion of operating cash flow over 6 months. Where to go? 37 to buybacks, biggest slice, but actually down 25% versus last year's repurchase pace. 14 to debt paydown. 8 to dividends, and this is the one, only $4.3 billion to CapEx. Apple is not, I repeat, not doing the $100 billion AI build-out the hyperscalers are doing. They're growing R&D, but the physical spending is muted. Plus 53% on operating cash flow first half versus first half. $82.5 billion in 6 months. The cash machine is running faster than the spending. That's the rebuttal to the R&D ramp worry. They can spend like this and still grow the balance sheet.
Forward look. What's coming?
6 product launches in the quarter. Most are refreshes, but the MacBook Neo is a new line entirely. Apple buried it in a single bullet in the 10Q. We don't have the segment breakout yet, but that's the kind of bullet you mark for next quarter. This is what Apple is already committed to buy. $44.6 billion in manufacturing, components, subassemblies, finished goods, almost all of it within a year, plus $30.5 billion in other obligations, content licenses, IP, distribution, rounded to $75 billion of pipeline that's locked. That's the floor under the next 2 quarters. The post-quarter event. April 30th, the board authorized a fresh $100 billion buyback. They still had $64 billion left from the prior program. So they have, what, $164 billion of buyback firepower lined up? Plus a penny bump to the dividend. This is the most explicit, we have more cash than we need signal a company can send. What I'd actually watch over the next few quarters, 2 things in red.
The DOJ smartphone case, equitable relief, which is we'll restructure your business, not you owe us money, and the Google search arrangement, which generates real services revenue and is now being reviewed for remedy. The yellows, tariffs, NAND and DRAM costs, the EU DMA, the Epic injunction, those are taxes on the business, more than existential.
Okay, verdict.
Bull side is frankly longer this quarter than it's been in a while. China back, iPhone re-accelerated, services margin at 77, cash flow up 53, $100 billion buyback fresh on the table. The bear case isn't that anything's broken, it's that R&D is running ahead of the narrative, and there are about 4 legal cases that could each cost something. The reads disagree about which side wins.
So I'll leave you with this one. Plus 34% on R&D versus plus 17 on revenue. Apple is quietly building something, and they're funding it from $164 billion of buyback firepower. So the cash isn't the question. The question is what shows up in fiscal 27 and whether the company that just printed its biggest March quarter ever is also the company that finally has an AI story to tell. The next 4 quarters answer it. That's it for today. Thanks for watching, and don't forget to subscribe.